Welcome to GRE. I'm your host, Keith Weinhold. Single-family and multifamily fortunes have largely separated from each other. Today, we're discussing multifamily's astounding 25% reduction in prices. And in fact, it gets worse than that. How bad is it? How does it compare to 2008? And where are the bright spots, if there are any, today on Get Rich Education?
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE from Springfield, Massachusetts to Springfield, Illinois, and across 188 nations worldwide. I'm Keith Weinhold, and you're listening to one of the longest running and most listened to shows on real estate investing. This is Get Rich Education, where I'm joining you from terrific, historic Boston, Massachusetts today. We've got some rather serious and rather dour topics to discuss today, outlining all the problems in the commercial and apartment real estate market. Of course, much of that pain is predicated on what happens when interest rates rise significantly on floating rate debt. We've got a terrific guest expert on this topic to provide perspective today. And you know, when we have a guest on the show, as opposed to one of my monologues, a lot of the time my mind is actually on you. That's because I'm trying to ask the guest the question that you would want to ask them if you could. This year has brought about a lot of new difficulties for the multifamily apartment industry. They really began last year. We're talking about things like failed deals and capital calls and having to raise bridge debt. And then there are the banking industry challenges too. We're going to talk about even the availability of multifamily loans themselves and the specter of an upcoming $1 trillion office assets apocalypse. How many apartment owners did actually get rate caps, those devices which put a ceiling on their interest rates, and how many did not get one? Rescue funds are forming for multifamily distressed assets. How about this multifamily contagion? Could that pour into the 1 to 4 unit space? Will rent prices shrink if there's a recession? And we're talking about all that and more today. Before we drip into a lot of the dreary stuff, hey, how about a little real estate levity?
I'm raising your rent next year, then I guess I'm moving. Nothing like the annual game of chicken with my landlord. I love that lease renewals have become ransom notes for your home. This place doesn't appreciate in value, you know. It's not a share of Amazon stock. It's a 1-bedroom apartment with an ant problem. I gotta cover the cost of maintenance. What maintenance? You talking about a caulk gun and a few new light bulbs? Use the thousands of dollars I continue to give you.
Yes, that is from comedian Scott Seiss, S-E-I-S-S. Seriously, though, a lot of tenants, they're not aware of a property owner's expenses. All those expenses, I sure wasn't when I was a rent-paying tenant back in the day. And back then, I didn't even realize that so many rental property owners even have mortgages. Let's discuss the beaten-down state of commercial real estate today. Today's guest is well known as the mad scientist of multifamily. He's a data guru, self-described process freak, and an outsourcing expert. He's a 10-figure man with his $1 billion-plus multifamily portfolio and his 900-plus investors. He's also the CEO at a multifamily education company because he's a really good teacher. It's been about a year and a half since you were first here. Welcome back to GRE, Neal Bawa.
Thanks for having me back on GRE. It's a delight to be back. I had a fantastic conversation with you last time, so I'm looking forward to this one.
We did. The last one was so fun and spirited, but my gosh, since then, Neal, about a year and a half ago, so much has changed in the multifamily industry. We know that a lot of new difficulties have come into multifamily, like failed deals and capital calls and the need to raise bridge debt and banking industry challenges. So where would you like to start to help give us some perspective on all that?
Opportunity is finally here. When we talked a year and a half ago, I said things like, well, prices are too high. I said things like, I don't know where the margins are. I don't know how people make deals work. I don't know how they make them pencil out. In some ways, I'm still saying some of those things, but it's certainly not because of pricing anymore. So the single family market is a perfect sort of benchmark for the world that I live in, multifamily. As far as I know, in the last 12 months, single family prices have either been flat or up 1% or down 1%, depending upon which analyst you pick. But it's certainly been an extremely, extraordinarily stable market in terms of prices, where the volume, of course, has cratered. It's down a ridiculous percentage. Whereas multifamily was an industry that has hurt more because of the portion of multifamily that was purchased or traded in the 2020, 2021, and 2022 timeframe. Almost all of those trades happened using bridge loans, which were floating, whereas almost all single-family transactions were 30-year fixed loans, right? So two completely different things have happened. Normally, the single-family and multifamily market tend to be in lockstep, and that's certainly been the case for 10 years. But over the last 18 months, single-family and multifamily have separated from each other. And the big reason for that is almost all of the distressed transactions that you're talking about, that you're alluding to, all of those cash calls, they are related to bridge loans, which had floating debt. And that floating debt has gone from, 6% to 10, 8, 11% even for some of these operators, making it extremely difficult to make numbers work, making it very difficult to pencil. But on the good side, compared to the peak, which was probably about 20, 21 months ago, we've seen a 25% reduction in prices, which is huge because multifamily usually as an asset class doesn't go down 25% simply because its value is based on rents, and rents rarely go down. They hardly went down for 6 or 7 months in 2008. So we didn't see much of a decline there in 2008 simply because the income was strong. But this time, the much, much higher cost of interest means that our overall post-mortgage income is down, and that's why prices are down 25%. So both opportunity and distress in the multifamily space.
That's such a staggering number. So let's frame that. Multifamily prices down 25% since their peak or year over year. And then just to be clear, we're talking about 5+ unit residential apartment buildings with that figure.
Yes, I'm glad you asked the question that way because I do need to qualify a few things. So first thing is down from peak, and depending upon different markets, the peak was either the last quarter of 2021 or the first quarter of 2022, and in a couple markets, even the second quarter of 2022. So I'm not saying year over year. Basically, they're down 25% in the last 18 or 20 months. So the second piece is that the down 25% is predominantly, let's call it, hotter markets in the United States. So if we're talking about a steady Eddie Midwest market like Kansas City or Indianapolis, then you're probably seeing a decline of half that amount. So maybe 12.5, 13, 14%. Where if you're talking about a very fast growing market, all the Texan markets, the Floridian markets, then you might be seeing declines of that 25% level. Since a lot of the transactions that did happen in the last 2 years were in the faster growing markets, that 25% number is still reasonable. And some people listening to this show might say, no, I don't think 25% is right. It's more like 20. It's more like 18. So I'll caveat that by saying it's a pretty wide range. We're seeing as little as 18% in some of these fast growing markets, hot markets. And we're also seeing markets like Phoenix where we're seeing 27, 28% declines in price. Also, the range is dependent on the number of units. We are seeing smaller declines if you've got less than 100 units, right? So smaller properties, we're seeing a smaller decline, maybe 15%. And then when we are seeing properties that are 300 units or more, just the whoppers, we're seeing 30% declines in those assets. So a lot of it is really dependent upon, because the bigger the size, the harder it is to finance it these days, that the less the banks want to take a risk on it. So the bigger the property, the harder it's hit at this point in time.
Bigger the property, the less liquidity. So maybe, Neil, to help the listener get a full understanding, maybe you could take us through the anatomy of where a common problem is with what happens to an apartment building owner or syndicator when they got this floating rate debt and they didn't get a rate cap and rates spiked. What exactly happens that makes these deals blow up?
First, I want to, set the size of the problem, right? So when you compare it to 2008, it's not comparable. In 2008, the total size of distress or potential distress was 8,000 billion or $8 trillion. So it was an absolutely staggering event. Luckily, not a lot of that distress actually happened, so that was good. The total size of distress was in that $8 trillion or $8,000 billion range. The total size of distress in the multifamily market appears to be in the $100 billion range. So about 1/80th of the size of the distress in 2008. So keep that in mind. Also, as a percentage of the overall multifamily industry, there's about 100,000 multifamily properties in the United States that are on the bigger size. Let's call them more than 50 units. There's 20 million apartment units total. 100,000 are the bigger properties. Of those 100,000, the distressed portion of the portfolios is about 3,000 properties. It could be as much as 4,000, but 3,000 is a very common number. So about 3% of the properties are distressed. And why are they distressed? Multifamily has been doing incredibly well. Rent growth has been phenomenal, especially in 2021, where it was 15%. Just so you know, the 50-year average is about 2% rent growth. So 15% is, champagne time. So we've certainly had positive trends, and we continue to see positive trends. There's less and less people can afford a mortgage. So there's brand new renters being created every day because of mortgage rates being this high. The downside was that a portion of those 100,000 properties were purchased in late 2020, 2021, and then 2022, and they were purchased using floating debt. So we're talking about those 3,000 properties. Those 3,000 properties either didn't have a rate cap. So when you were purchasing using, bridge debt or floating debt, you want to buy a rate cap. So if rates do go up, they hit that cap, and then anything above that cap is something that the rate cap selling company reimburses to you. So that way you're not affected by going above that. Well, some of these operators neglected to buy a rate cap, which was a really bad thing to do. But then there were other operators that bought a rate cap, but their rate cap was set too high. So they basically didn't think that rates would go up. So they did put a rate cap in, but instead of buying a rate cap at 6% or 7%, they maybe bought a rate cap at 8 or 9. They were basically looking for the worst case scenario. And so they bought the cheapest rate cap that they could find. And now, rates have gone up and they've already hit that rate cap. Maybe it's 8.5 or 9%. And at 8.5 or 9%, that mortgage is still too high for that property to cash flow. So now the property has negative cash flow. So I personally know of a few dozen properties where the negative cash flow is between $20,000 and $200,000 a month. And that negative cash flow means that the syndicators, the general partners, are basically putting that money in themselves, or they're taking short-term loans, and they are now looking for a solution there. And their solutions are limited. I can give you a list of those, but their solutions are limited because the property is negative cash flow, and nobody wants to touch a property that's negative cash flow.
Did we say that he's a data-driven guy or what? That was some great perspective that the magnitude here of the multifamily reset problem has been about 1/80th of what the problem was in real estate during the global financial crisis. Yeah, Neil, it's such an interesting mindset that an operator would have the awareness to buy a rate cap with their floating rate debt, but yet not have the cap be low enough in order to keep them out of trouble. That's really unusual to me. Do you have any idea what percent of operators have bought a rate cap with their floating rate debt?
I think a majority of them have. So I'd say more than 50% of the properties that were purchased during this time did have caps, but a lot of the caps were set high. So that was a very common thing where the caps were set to 8% or higher, as opposed to them being set at 6 or 6.5%. So it's more of a high cap issue rather than a no cap issue. And I think the secondary challenge is, let's say they had a good rate cap, right? Let's say you bought a property in let's call it the final quarter of 2020, and you bought a 2-year rate cap, and the rate cap was good. It was 6.5%. Yay, good for you, right? But that rate cap was a 2-year rate cap. So now it expired basically last year. And so since last year, you're now up at 10 or 11%. And, a year's gone by, your property is bleeding. Maybe it was doing well, but now that it's been bleeding for a year and you've been paying all of that bleed out of your operating, expenses, now you're in trouble. And maybe you bought a 3-year rate cap. Well, if you bought the property in the final quarter of 2020, then in about a month or 2 months from now, we're in the final quarter of 2023, well, that rate cap's going to be gone. And then maybe in the next 3, 4, 5, 6, 7 months, all of your operating budget, all of your operating fund is going to be gone because you have this much higher mortgage. So what's happening is that this is one of those situations where there isn't a trigger on any one particular day and a huge number of properties come to market. There were a lot of properties purchased in the final quarter of 2020, all 4 quarters of 2021, and the first 3 quarters of 2022, right? So you're looking at a total of 8 quarters. So each quarter, a certain percentage of those properties get to the point where either their rate cap is gone, it's finished because you bought a 1 year or 2 year rate cap, or they're at the point where even without the rate cap, their loan is expiring. So a lot of these bridge loans were 2 year loans and 3 year loans. And so the vast majority of the challenges that the multifamily industry is going to face are going to be in 2024, because that's when a vast majority of either rate caps or mortgages expire. And because the net operating income of these properties has gone down and the mortgage cost has gone up, most of these properties cannot be refinanced. So I'd say out of the 3,000 properties, you could probably refinance using some mechanism, 1,000 of them, maybe a third of them. And that could be, do a cash call, get money from your investors, or you could do what is known as a pref lending, where you basically take money from an outside party and that extra money helps you refinance into perm debt. So those are your options. And the third option, which is likely to be most common, is that you go out and sell your property. But from what I'm seeing, the vast majority of these properties that don't get refinanced, so out of 3,000, the 2,000 that don't get refinanced, are likely to come to market, and the vast majority of them will end up losing all of their investor money or a majority of their investor money. And so if it's a $100 billion problem, that's, we're talking about $30 to $40 billion of investor money, and a majority of that $30 to $40 billion could be lost.
That is troubling and really concerning. As far as those LPs, those limited partners, those investors in someone else's syndication, hopefully that syndicator, that operator is communicating with their investors. But for investors, is there anything they can do to identify cracks in the armor where they might be losing their deal, where they might be losing their money, where they might be throwing good money after bad if a capital call is requested?
It's a very difficult thing to do for a limited partner because you have much more exposure to the deal than you would when you invest in the stock market, where there's almost no exposure unless it's a public company. And these are all private syndications. But I think that a lot of investors simply don't know how to read the budgets versus actuals. They don't necessarily know how to read the pro forma, so it's challenging. So if you're somebody that is comfortable doing that, I suggest you dive in and basically ask a lot of the questions of the syndicators. I have one such property. So, I was lucky in that I have people who I know, colleagues, that bought 10 to 12 properties during that time frame. It was very normal. I bought 1.5. So one of those properties was my own property. I exited one of my partners. So I call it a half a property because it was already mine. I purchased one other property in a military metro. So I was able to get it for a lower price because it was a military metro, and usually the prices are lower for military towns. And that property, I'm having the same challenges that I've described, rate cap issues and the fact that basically prices have gone down by 25%. And I'm dealing with it by constantly communicating with my investors, giving them options. Here's when we were all selling these shares to investors, we gave them a sensitivity analysis showing them, worst case scenario, best case scenario, and a middle case scenario. And so now we're basically doing a sensitivity analysis based on what we are seeing in the marketplace today, and giving them feedback on what our options are. And I think a lot of it comes down from the general partners communicating with the limited partners. And if your general partner is not very communicative, is not giving you information, ask for one-on-one meetings. Ask for more information in their webinar or in their updates. I think this is a time for limited partners to be vocal.
You've learned about the problem in the larger apartment space. You've learned about how operators and apartment syndicators are dealing with the problem. And then, Neil, where do you think that we're going next? And maybe we should ask and look at it through the lens of where do you think we're going next with the availability of multifamily loans? Could this help the source of capital dry up?
We are going to a very dark place with availability of commercial loans. Multifamily is in a privileged asset class, so the term commercial real estate is sometimes meant to include multifamily, sometimes not. So I'll assume that multifamily is part of commercial real estate, but there are many other asset classes. So there's office, which is the next biggest asset class. There's retail, hotels, there's self-storage, and a few others like mixed use. And of those commercial real estate asset class, there's only one that's privileged, and that's multifamily, because there are not one, not two, but 3 lenders who are government or quasi-government organizations whose only job it is to keep lending in the multifamily space liquid and also the single family space liquid. And they are Fannie Mae, Freddie Mac, and HUD, right? So Housing and Development Authority. So these 3 lenders right now are extremely, extremely active. And what has happened is that in good times, early 2022, you had life companies, you had all these private bridge capital, you had all kinds of capital that was lending to the multifamily space. Now, some of that capital has backed off. There's still a huge percentage, I'd say probably 40-50% of all loans that are being done today are these kinds of private groups. But I think the government or quasi-government groups are much more active today, and they're lending. So I don't think multifamily lending dries up at all. I don't think that that's the case. I think it dries up for the non-privileged asset classes: hotel, retail, self-storage, office. These are the classes that are likely to see lending dry up, especially because on a fundamentals basis, there's absolutely nothing wrong with multifamily. In fact, as I mentioned, we're a lot better off than 2019 to 2023, given that home prices have gone up 40%, incomes have only gone up 15%. So there's a very large number of Americans that simply cannot qualify for a single family home anymore. And so those people have to go to apartments. The fundamentals are really good for apartments. That is not true of office. So office is an asset class that is experiencing the worst fundamentals it has seen in its entire history. There's going to be very severe lending challenges in the commercial real estate space, but I haven't really seen that in multifamily, and I don't anticipate seeing it in the future as well.
Well, I don't know if Neil and I could have as much fun as last time. There are rather gloomy subjects to discuss here. When Neil and I come back, can this problem in the multifamily space create contagion for the 1 to 4 unit space? And like with what Neil touched on, what about other commercial sectors like office and retail? How troubled are they? More when we come back. This is Get Rich Education. I'm your host, Keith Weinhold. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4 plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time. So it's steady income, no surprises while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Welcome back to Get Rich Education. We're talking with the mad scientist of multifamily, a big-brained visionary. He's also an excellent teacher. I'm sure you can tell as you're listening to him here. And if you're listening in the audio only, Bawa is spelled B-A-W-A. Here on this show, we talk an awful lot about investing in the 1 to 4 unit space and the advantage of the 30-year fix, that long-term fixed interest rate debt. Do you see any areas for contagion with problems in the multifamily 5+ unit space bleeding over into the 1 to 4 unit space?
Yes, but to a limited level. The 1 to 4 unit space is the healthiest that I've seen it in a very long time. And there's reasons for that. One of the biggest reasons is multifamily, which is the most well sought after asset class for institutional investors. You don't usually like the 1 to 4 unit space. There's a few companies in that space, let's call them half a dozen. But there's several thousand companies that invest in the multifamily space. Some of them are right now looking at single family as a safe haven to park some of their money, right? So there's, more institutional level interest in the single family space because of its access to those 30-year fixed loans and the fact that single family prices basically haven't declined. There's a lot of interest in the single family space. Keep in mind that millennials are reaching their peak years of household formation. So they started in 2019. So until 2025. So from 19 to 2025, those are the peak years of household formation for millennials. And that's also putting a cushion under the single family space. Some form of contagion is inevitable. I think that the office market is going to see spectacular levels of contagion similar to 2008. The other associated markets like hotel and retail are going to see some level of contagion, though I certainly don't expect it to be as bad as office. And then multifamily is going to see some contagion, as we mentioned, because of these 2,000 or 3,000 properties that have to be basically sold into the marketplace. And prices are down, which always creates contagion. Why? Because you're a mid-level bank. So a mid-level bank in the US is $250 billion or less in assets. Well, a lot of these banks are the ones that loaned out money to multifamily and retail and hotel and office, and now are being forced by the Federal Reserve through a process known as mark-to-market. They're being forced to write down the value of these assets, because these assets, they're still active loans, but maybe they loaned $20 million and now basically their $20 million is only worth 18 or 16 or 15. And so now the Fed is saying, hey, you got to mark these assets down in value. And as they mark them down to value, that can lead to the banks becoming, or mid-sized banks becoming, less stable. I don't think this affects any of the large banks in the US, but the mid-sized ones are affected. And some of those mid-sized banks do lend to the single-family space, but not a lot. I find that the single-family space, when I look at their source of lending, not a lot of those mid-sized banks are involved. There's a little bit, they do some brokerage work, but then they're selling those loans back to Fannie Mae and Freddie Mac and a bunch of other governmental type organizations. So I don't see a sense of contagion in the single family space. I do see potentials of some price declines, because until about 2 months ago, mortgages were predominantly in the sixes. They spiked up once to the sevens and then they pulled back into the sixes. Now they've gone into the sevens and they may stay in the sevens for a substantial amount of time. When that happens, that can affect the single family market as well, simply because you can get to the point where supply is higher than demand. So I wouldn't be surprised if there's a pullback in single family prices, let's call it 5%, but I'm not predicting the kind of challenges where the office market, I think we could see 40% declines in prices from peak, whereas single family, you might see 5%. I think that's still an incredible outcome for the single family market compared just looking at the outrageous increases in prices since COVID. I don't think that's even a pullback. I would just say that's a balancing out.
We know the residential housing market, really, it's something that's non-discretionary on a human need basis. Everyone needs to live somewhere, and they will either own, rent, or be homeless. So you talked about some of those affordability challenges before. The lower the homeownership rate gets, the more renters you have. So long-term, we will have some demand baseline for both multifamily and properties in the 1 to 4 unit space, of course. But the same thing cannot be said about some of these other commercial sectors, especially the troubled office sector space, where you have more and more abandoned buildings downtown, and a lot of these office buildings cannot be easily converted from offices to residential units. So why don't you talk to us about some of those other troubled commercial sectors, starting with office?
Office is in a apocalypse. I think that this is far, far worse than 2008 and far, far worse than 2001, because 2008 and 2001, they were liquidity crisis. They were short-term demand crises. This is a long-term demand crisis, because I read very important documents from companies that are in the key swiping business. When you enter an office in a downtown core, you're swiping your card. And so those companies actually have phenomenal day-by-day data of how many people are actually going into offices today. It's been more than a year since companies started calling back people to the office. And I think that by now, every company, whether they're forcing 5 days back to the office or 4 days or 3 days or 2 days, everyone's sort of put their line in the sand, and we're at the point where this is what offices look like going forward. And if I'm right, and this is what it looks like going forward, it is simply catastrophic for the office market in the United States, because we're still seeing key swipes at 50 to 60% of the people that used to swipe in before COVID. And that number is staggeringly low. And if this is what it settles at, some companies at 2 days, some 3, some 4, I think we're in for a world of pain for the office market. There's a lot of people that in these podcasts basically will often say something like, no, the office stuff will get converted into residential. Now I have news for you. Only 3% of office buildings in downtown cores have the floor plate necessary for residential conversion. Why? Because residential conversion by law requires that every single room have a window. So what is happening is most of the time, you basically can only convert the buildings on the square footage on the edge of a building, but that central core then becomes worthless. And if you don't have a use for it, then you still have to buy that office building to convert it, and you have to buy it at a reasonable price. The math doesn't work. I mean, you'd need to see office values down 80% for somebody who's converting to multifamily to say, fine, I'll just leave the 60% in the middle empty, and I'll just convert the sites. So 80% declines in value are needed for that kind of conversion to happen. So we are about to see a 10-year problem in the office sector, and it's also dragging down all of the other assets in the downtown core. So we just saw a $727 million default on 2 hotels in San Francisco. We saw a $558 million mall default also in San Francisco. We're seeing defaults across the board in New York, Boston, Seattle, San Diego, Miami, sort of heavy markets where these challenges are happening. We're seeing a lot of these. And it's happening in a very, very slow way, Keith. And the reason for that is the office market, their average lease is 5 years long. Some leases are 10 years long. And a lot of these companies haven't gone out of business. So that if the company is in the lease, they're continuing to pay even though the office is empty. But the moment that lease comes up for renewal, either the company doesn't renew it or they renew maybe half the space. And so we already know that this is an incredible debacle, but it doesn't seem like it at any given point of time because it's happening in a very slow motion way.
That's such a good point about how there will be this slow drain, this slow leak when these office leases expire over time. What about other areas of the commercial space? Any other particularly troubled areas or bright spots that you see going forward?
Ironically, bright spots. And this is where I've been proven wrong in the past. I've often, maybe 4 or 5 years ago, talked about the retail apocalypse,
right,
where Amazon would basically, lead the retail market to become illiquid. Well, none of those things have happened because of 2 reasons. One is the retail apocalypse with people like me, being on 200 podcasts talking about it. A lot of development of retail that was scheduled to happen simply didn't happen. So we've had very many
podcasts. People lost confidence, know to invest in the retail.
Exactly. Sure. I fulfilled that prophecy, I think. But bottom line is that there's been very responsible levels of new construction in retail. So that, they haven't built a lot. Very few malls have been built in the United States in the last few years. And even some of the malls that have been repurposed, some of their square footage has been used up for multifamily. And so that was one. The second reason is that retail has been very careful with pricing. So over the last 5 or 6 years, the retail market has adjusted to new forms of pricing where you go into a mall and you see a gym, where before the pricing of that mall never really allowed for a gym to be in a mall. It's just gyms, they want, a lower price per square foot. Strip malls have adjusted. And so today we have a surprising event where retail occupancy in the United States is higher than multifamily. This is the first time ever that multifamily is about a little under 95% now. It's 94% occupied. Retail is 96 or 97% occupied, which never happens, right?
Yeah.
Normally retail is right around 90%, 88%, something like that. But the high level of occupancy shows that retail is doing well. Now, having said that, so on the occupancy side, they're doing really well. There's really no pullback in terms of demand. But on the other side, because of the fact that interest rates are so high, retail cap rates are very high, which means prices are low. So prices are very reasonable there for retail. And so I think that real opportunity that I'm seeing, I wouldn't invest in office at this point, Keith, because you don't know the end of this process. You don't know how long it takes. I think it takes a decade. So I might get 50% off in office and I don't want it. I just don't want to touch that asset class. It's tainted. Now, if I get 40% off in retail, I think I'm interested because fundamentally, I don't see a demand issue. If this is the highest occupancy that retail has seen ever, and at the same time, I'm getting a 40 or 50% discount simply because of lack of lending, well, that is, to me, a classic opportunity to look at. Because once again, fundamentally, nothing is wrong with demand. I realize that the Amazon effect is extremely real, but what I'm seeing is that people want that experience of shopping. And so even amongst the young people, sure, each year Amazon goes up a little bit, but now Amazon's growth is no longer a hockey puck. Amazon's growth is sort of like this. They're growing by 10%, 15% a year, which is still great for Amazon. When you project that across a 300 million person market that the US is, retail no longer has to fear for an apocalypse. So this is actually a pretty good time to take advantage of the 40% discounts that I think will happen in 2024 for retail. everything I just said also applies to hotels. Hotels came out of the pandemic very strong with huge increases in ADRs or average daily rates and huge increases in occupancy. So hotels right now are a very robust cash flowing business. If you've got good hotels in good locations, you're making a lot of money. They're cash flowing like crazy because their ADRs have gone up and their occupancy has gone up. So they've taken two positive hits. But once again, I expect there to be discounts simply because of a lack of funding, a lack of loans. We might easily see 30%, maybe not 40, but 30% discounts in hotels in the next 12 months. So I think both of those are really good opportunities along with multifamily discounts at 25%. So this is a case of distress creating unusual levels of opportunity. I don't think we're quite there yet, Keith. We're beginning to see some distress in multifamily. We're certainly seeing distress in office. We haven't heard anything about distress in retail or hotels yet. That's because a lot of their loans don't trigger until 2024. We'll see what happens next year when these loans start to trigger and you can't really refinance them.
I completely believe that inflation has thoroughly soaked in to hotels. You talk about their ADR, their average daily rate. I've recently stayed at hotels in Denver, Omaha, Chicago, Toledo, and Boston. So I've gotten a pretty good sample size, and I sure feel the hit there. And interestingly, the last time I shopped at a mall, it was the biggest mall in this city, and I noticed a bowling alley that I had not noticed there before, and I went bowling, and I noticed an ice skating rink was there. So I just wonder how much retail can reinvent itself if it tilts enough into the experiential part rather than just buying items off a shelf at a store. Maybe that can help sustain that retail sector, to your point. Well, Neil, maybe we should wrap up really on what supports an awful lot of values in multifamily, and that is rents and the direction of rents, especially if we have, I almost hate to say this R word, a different R word, a recession, because it seems like this thing has been around the corner forever. I know historically that rents are quite resilient in a recession, something that you touched on earlier. Back even during the 2008 global financial crisis, when I was a landlord, I owned fourplex buildings then. I noticed that I had a pretty good steady stream of renters. My rents didn't really go up much, but they were really resilient. They didn't go down. And that's because people couldn't get a loan. So that was an affordability problem then. We have another affordability problem now. But if we do tilt into recession, what do you think that is going to do to rents?
We are going to see a decline in rents if a recession happens. Now, that's a question, by the way. 6 months ago, if you told me a recession wasn't going to happen, I'd say, no, that's not possible. We are going to go into a recession. However, I must admit that the U.S. economy has truly outperformed beyond anyone's imagination. So today, the chances of a recession are certainly not 100%, might be 50%. But let's assume that it happens and a recession happens. I think what is very, very likely is that this recession will be very short. So once again, if you're not paying attention to what's happening in the marketplace, this is a time. I was born in India and this is my adopted country. I feel very proud of the U.S. economy today. If I compare the U.S. economy to the Canadian, the Eurozone, the Germans, the Japanese, we are outperforming every one of those economies. We're at the point where we're outperforming China, which almost never happens, by the way. So we have an extraordinarily resilient and strong economy at this point. So if it falls into a recession just because the Fed keeps hitting it over the head with this interest rate hammer, I think that recession will be fairly short, because as soon as the economy does go into a recession, the Fed usually figures that out within a few months. Then they can stop hitting us with a hammer. I'm not saying that they'll just cut interest rates back to zero, but they certainly will provide some cushion. Maybe they cut rates by 1 time, 2 times, just to make the market breathe a little bit easier, because this is an artificial recession. There is no shortage of demand in the U.S. economy. There's an incredible number of open jobs. There were as many as 11 million jobs. Now there's about 9 million open. So and wage growth has been so strong, right? Because we have so many people retiring that at this point, for the first time since the early 60s, I believe, or late 60s, we actually have pricing power. So anyone who wants to be employed can ask for more money and get it. And so wage growth has been about 4.5%, which is really good for rents, by the way. It's phenomenal news because we needed wage growth for future rent growth. So we have a artificial recession if it does happen. And that artificial recession is being caused by the Fed because they want that wage growth to come closer to 2% from the 4% that it's at, because everything else has come down, right? So commodities have come down with the exception of oil. So the supply chain issues are gone. Rents are down. So in the US, the last 12 months, rents were flat. And in some markets, they might be down 1% or 2%. Austin, I think, was the only market that was down a lot. But most other markets were down very, very small amounts. So rents have been flat, which is really credible because if you look at rents over the last 2 years, they're up 16%. So in 2022, they were up 16%. In 2023, they were up basically zero. So if you average that out, now you're looking at 8% rent growth, which is phenomenal compared to the long-term average of 2.5%. So we've been outperforming on rent and we needed to take a breather, and the last 12 months have been that breather. Now, if the recession happens, I do expect rents to go down, but normally they don't. So in a 6-month average recession, the average US recession is 2 quarters, so 6 months. Normally you don't get rent drops. You might get, the rents plateau out, or maybe their rent growth drops from 3% to 1%. That's much more common. This time, we might see rent growth in a short recession drop by maybe 1% or 2%. And the biggest reason for that is supply. The largest supply of apartments in the history of the country is delivering starting basically the beginning of 2023 until the end of 2024. So these 2 years, 2023 and 2024, are massive apartment supply years. And obviously, as you supply 500,000 apartments into an economy that overall is not outperforming, is doing okay, and it starts to go into a recession, then you're going to see some concessions, and that concession drives down the price of multifamily, which then drives down the price of single-family rentals. So we could see a decline in rent. I'd say probably 1% to 2% is possible, but that decline is likely to be short. So let's assume that the recession starts in the final quarter of 2023, which might not happen. I think it's more of a Q1 and Q2 of next year. If the recession does happen, those are the 2 most likely quarters. As soon as the economy rebounds and becomes positive, we should see very stable rent growth for the rest of 2024. By 2025, a lot of that incoming supply is done. So now supply and demand are in balance. So in 2025, I expect strong rent growth as much as 4 or 5%. And in 2026, I expect very, very strong rent growth. We might see 6% rent growth in 2026. So 2024 is that year where rent growth's a little bit shaky because of this R word, the recession word, and whether it happens or not is we don't know. And when it happens, we don't know how long it lasts. But I think because it's an artificially induced recession, it's likely to be the vanilla US 6-month recession, which basically drives wages closer to that 2% target for the Fed and gives the Fed the room to start easing up on interest rates.
Recessions are not good. Perhaps the one positive about a recession is that then we can all stop talking about and speculating upon when it does eventually happen, because on average it does happen every 5 years. It's just a normal part of the business cycle. Well, Neil, this has been very informative around the multifamily world and beyond, including projections for the future. You've always got such great insight and stats on the pulse of the market. If someone wants to learn more about you and your resources, what's the best way for them to do that?
Come join us at MultifamilyU.com. That's multifamily followed by the letter U.com. We get about 20,000 registrations in our webinars. We do about a dozen webinars each year. We do them on single family, multifamily. We do them on other asset classes like office. We just did one on the office apocalypse. And people like that because there's no education fee. There's no subscription. There's no upsell. People come join us. They learn a lot. And occasionally during one of these webinars, if we have a multifamily project that we are doing, we mention it for about 30 seconds. And if that sounds like it's interesting, you can jump in and participate. But otherwise, there's a lot of tens of thousands of people that have never participated with us in any of our projects that come and join us at this ecosystem of learning called multifamilyu.com.
Neal Bawa, Grow Capitalist, and MultifamilyU.com. It's been informative, just like it was the last time you were here. It's been great having you back on the show.
Thanks for having me on, Keith.
Yeah, valuable insights with Neal Bawa. You may very well want to listen to today's episode 2 or 3 times in order to aid in gathering all that. I've learned about some office buildings in some areas already down 40% or 50% or more in value. And, I think that some lay people, they haven't made the connection that offices have actually been squeezed from both sides. Its income down and its expenses up at the same time. Office income, of course, down from the work from anywhere trend, and expenses up due to the rates being hit from both sides there. But back to multifamily, hey, there are some good, prudent multifamily operators out there, no doubt about it. But you know what's interesting? Everywhere, All my life, every single apartment syndicator that entices you to invest in their deal, they all use one word to describe their investing style across the board. And this one word is that they all say that they're conservative. They're conservative with the handling of your invested dollar. Maybe they were, but soon we'll find out who was really conservative if we haven't found out already. If you'd like to share the episode or read the show notes to help supplement today's show and more, as always, you just go to our homepage and really just add a / and the episode number. Since you just listened to episode 473, therefore this week, all of this is at getricheducation.com/473. Next week, a big discussion with one of the brightest and most followed macroeconomists in the world. We'll get his insights and how that relates to your personal finances and your real estate investing. Until then, I'm your host, Keith Weinhold. Don't quit your daydreaming.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.